I have trapped Cern Basher on a Sunday afternoon. Who knows? He might prefer to be watching football right now. I certainly would, but here we are anyway. And we're going to give you, my understanding is you're going to give some thoughts, direction. Potentially, you could even get down to financial advice or not. I'm not sure regarding retirement and retirement pension funds and et cetera. Is that right?
Specifically, Roth conversions.
Roth.
When should you consider doing them?
Oh, okay. And this is a good timing because we're sitting here almost at the end of the year, and people might want to do it before January 31st. I mean, sorry, December 31st. Is there some advantages to that, or you'll talk about that?
Well, it gets it into this tax year if that makes sense for people. So
Yeah.
yes, that's there's a time clock on that. And of course, the other thing is some of your viewers might be holding shares of a certain company that might do really well in the years ahead.
Yeah. And
So,
how this would might impact that.
right, where should that certain company be held?
Okay. So if you have a company that's not you're owning shares in a company that's not going to do that well, it may not make as much difference as if you own a company that might be doubling or tripling.
That's true. That is true. We'll show that math today. Yeah, as well as a few other considerations.
All right. Well, just really quick before we get started, if you want to really figure out what's going to happen in the markets, they should buy the book, right?
Well, I don't know about the markets, but just life in general.
Well, the AI part of the market right
Yeah,
now is like that's all that anybody talks about is the
good
AI
point.
part of the market.
That is the market.
Yeah,
Yeah,
that is the market. So
yeah.
anyway, buy the book, buy the book. The information's down below in the information. All right, sir. That's enough commercials for right this minute.
Yeah, and just actually on that real quick, Elon in a recent interview said he was asked about what he would invest in.
Yeah.
And Elon says, well, he doesn't have a portfolio. He just builds companies and owns the stock in those companies. But he did basically say that AI and robotics would account for the vast majority of the stock market's value at some point.
Right. Right.
So I think you and I are in agreement with that one.
There you go. That
Yeah.
was that was a nice little interview today. I've only seen half of it, but I'm going to try to get it all in later today. All
Yeah.
right, I'm going to turn it over to you. I will probably have a question or two, but let's see what you have to say.
That sounds good, Randy. Yeah, this is going to be a discussion about Roth IRA conversions, the sexy topic of Roth IRA conversions.
So sexy.
When does it make sense?
Yes.
Right. And
Or
so,
dollars, or dollars potentially.
well, that's right. Dollars and cents.
Yeah.
Yes. No pun intended there. So the usual disclaimer applies, but even more so today. It's not only not investment advice, but we're not providing tax or legal advice. And this topic actually touches on all three areas.
Yeah, I guess I should have had my own disclaimer. I'll do a verbal disclaimer. I'm a graduate of law school. I never took the bar. I have no ability to give any kind of tax or legal advice. So anything I say should not be considered as either one of those either.
But it is important to say here that we will have a good discussion around this, and
Right.
hopefully it'll give people a good sense of how it might impact their situation. But the reason that nothing we say is advice is because we don't know anybody's specific situation, and the specifics really matter here.
Yeah,
Okay? And hopefully that is something that comes across.
100%.
And by the way, the reason that we're doing this today on a Sunday is because 180 people, 191 now, have expressed interest in hearing about this topic on a post that I did this morning. So it seems to be in great demand. So hopefully this is helpful to people.
Hopefully.
All right. With all that out of the way, let's get into it. So here's the core idea, Randy,
Okay.
is that if you have stock investment in an IRA or some other kind of tax-deferred retirement account, you can, in theory, take that money and transfer it, convert it into a Roth IRA. And so what you end up doing is you pay taxes now on the amount you convert at today's tax rates,
Okay.
whatever that is for somebody.
Right.
And then that would mean that future growth and withdrawals are tax-free forever.
Right.
Now, notice there's a little star after that forever part. Nothing necessarily is forever in this world because the government and certain administrations, every administration, likes to change the rules on things. So this is based on sort of today's environment, today's tax rules. So it's forever with that little asterisk next to it.
Okay, I'm already confused. So if I put the money into a Roth and I put 100,000 into my Roth and it grows,
Yes.
and next year, in fact, we invested in Tesla and it doubles and it goes to 200,000.
Yes.
I can withdraw the entire 200,000 without tax.
Well, not in the next year, but if it's been in there 5 years, you can.
If it's been in there 5 years, you can
Yeah.
withdraw the entire, even the gains.
Yes,
So,
the gains, but you can withdraw your contributions
okay,
at any time.
right,
The amount you put in initially, so the 100 can
right.
come out, but it can be the gains. Let's say it's going to 200,000. After 5 years, that can come out without any tax. Correct.
Okay, and that is after establishing the Roth, or is that 5 years after you made the gain?
5 years after putting that money in.
Okay,
Yeah.
okay, all right, good.
Okay. So
Okay.
the question that we're going to try to answer is paying taxes now versus later worth it?
Yeah.
Right?
Listen, I've already learned something. I didn't know that you didn't have to pay taxes on the gains. That's pretty
Correct.
significant.
Yes, it is.
Yeah.
Yeah. So let's just review a few things. Okay. Just kind of set the stage here. So U.S. income tax rates, as most people would know, that we have different tax brackets. And we've got 4 different tax filing types here. And today we're pretty much going to focus on the single and the married filing joint.
Okay.
But there's also something called head of household and married filing separately. These are less common.
Mm-hmm.
We have different tax brackets. So for the single filer, from an income of $0 to almost 12,000, it's a 10% tax rate.
Okay.
And for joint, it's up to about 24,000. I'm just rounding numbers here. This
And
is
that's
for
after
2025.
That's after deductions. It's after, it's the net of all those things.
Yeah. Yeah. And we're not going to consider any of that. We're just simply going to look at
Right.
these numbers and not factor in those other things that can reduce your taxable income.
Right.
And then you can see your tax rate goes up as you hit different thresholds.
Mm-hmm.
Okay. And in general, the married filing joint thresholds are twice as much as the single, roughly.
Mm-hmm.
Okay. Not exactly in all cases. Okay. And so the tax rate goes from 10% on all the way up to 37%. Okay. And again, this is 2025 numbers. It'll be different for 2026 in terms of the numbers here that set these brackets.
Okay.
They're typically adjusted for inflation each year or something like that.
Mm-hmm.
At least they attempt to.
Right.
Okay.
Yep.
All right. So we've got this graduated tax rate system, different brackets apply to different levels of income. Okay. We also have, for people that are on Medicare, a consideration that is important. It's called Income Related Monthly Adjustment Amount, IRMA. Okay. And so it's based on your modified adjusted gross income reported on your tax return from 2 years ago. Okay. And so, for example, if you're married filing jointly and you make 212,000 or less, then the premium on your Part B is $185. Okay, from your Medicare premium for Part B.
Okay.
If you're above 212 and not any higher than 266, then that jumps to 259. So as your income goes up, these premium amounts also increase.
Okay.
Okay, you're paying more because you have more income.
Right.
Okay, and that affects the Part D payment as well. So this is a consideration for people that are converting money from an IRA to a Roth. They may inadvertently put themselves in a different bracket.
Okay.
And without knowing so, 2 years from now, they're going to be paying more than these premiums.
Looks like about $1,000 more if they got into the next bracket.
Something like that.
A year. Yeah.
Yeah.
Okay.
Right. And some people, this is a shock because they don't realize this. They don't think about this. So I just want to throw that out there at the beginning.
Good.
Be aware. Okay. All right. The other consideration is, as I mentioned earlier, that tax rates can change.
Sure.
And we have this Tax Cuts and Jobs Act, right? If it expires in 2026, the rates for the different tax brackets could change. So the 12% bracket, for example, could become 15.
Mm.
The 22 goes to 25. The 24 goes to 28.
Mm.
The 32 goes to 33. The 35 goes to 35, no change. And the 37 goes back up to 39.6.
Wow.
They couldn't quite do 40, Randy. They had to
Yeah.
control themselves. Yeah. So there's that consideration, right? So again, this is always in flux. We never quite know what the tax rates are going to be over time.
Right.
They could go up, they can get cut. That's
The
totally out of
president,
your control.
the president might get Congress to agree with him that we should eliminate income tax altogether, which will really change things.
Well, I wouldn't hold out hope for that this anytime yet, but maybe one day. Yeah. And then the second thing is the tax brackets themselves, the numbers that represent the
Mhm.
brackets
Mhm.
also change, not only with inflation, but again with tax rules.
Right.
So again, in the same situation here, if this Tax Cuts and Jobs Act expires, for example, the seventh rate currently begins at 771,000, but it would go down to 615.
Wow. Wow.
Now, the good thing about these two situations, the rates changing and the brackets changing, is you kind of know in advance, and you know for that tax year. This is not necessarily going to be a big surprise or an unknown during the time that you do the conversion,
Hmm.
but just know that none of this stuff is necessarily in stone.
Okay.
We could add more tax brackets. We could change the bracket amounts. We could
Right.
change the tax rates. There's all kinds of things that could change over time. Okay.
Hmm.
How much can you put in a Roth IRA? Well, if you are single and you make under $150,000 a year, okay, and you're under age 50, you can put $7,000 in for 2025.
Okay.
If you're over 50, you can put $8,000 in.
Hmm.
Okay. And that income threshold for married filing jointly is under 236,000.
Hmm.
So if you don't make any more than those levels of income, you can just fund a Roth directly.
Hmm.
$7,000 to $8,000 a year, depending on how old you are.
Wait a minute. If you're married filing jointly, it's still 8,000?
If you're over 50. Yeah.
Okay.
Yeah. Okay. Now, as you hit these thresholds, you can see that these numbers start to come down and you get phased out completely by the time you're at 165 for
Hmm.
single
Hmm.
and 246,000 for married filing jointly.
Hmm.
So again, this is something to be aware of in terms of just being able to fund a Roth
At
directly
all. At
at
all.
all.
Right.
Yeah.
Now that doesn't probably affect conversions. I'm probably getting ahead, but
Correct.
okay. Okay.
Yeah, we're just talking about the simple case of putting money
Putting
in a
more
Roth.
in. Mhm. Okay.
Okay. Now, here's a couple things that some people might not recognize. That can you contribute an IRA to an IRA for a spouse? Yes, you can contribute to an IRA for an unemployed, non-working spouse that you filed jointly with.
Hmm.
But your total combined contribution can't exceed either your joint taxable income or double the annual IRA limit. So
Hmm.
you could put in, if you're over 50, 8,000 for you, 8,000 for your spouse.
Okay.
Again, assuming
Yes.
that your income is at least that
Right.
much.
Right.
Okay.
Hmm.
Can you contribute to, can a minor contribute to an IRA? And this is something that's actually kind of nice for people whose kids earn an income,
Yeah.
right? And a lot of kids do.
Uh-huh.
Minors can contribute to an IRA based only on the limits of their own earned income, not that of their parents.
Hmm.
So you might be over the limits
Hmm.
and not able to contribute, but if your children, if your child is earning income, they can contribute that $7,000 or up to that, depending on what their income is.
So if I hired my child to mow the lawn and do the dishes and stuff, I could pay him and he could contribute to my IRA.
Well, I think you have to be a little bit careful with that in terms of, payment within the family. I would talk to your tax advisor about what you can and can't
Okay.
do there.
Right.
Yeah, no, you have to be careful about that. But if it's a legitimate work,
Hmm. Hmm.
from a legitimate job, yes. If it's
Okay.
within the family, just you need to be very careful. I would seek out advice on that. Okay.
Yep.
Um, but this is really nice. A lot of parents kind of treat this as they say to a child. Let's say the child earns $5,000 in a summer for work.
Hmm.
They say to the child, "You earn the 5,000. I will match dollar for dollar the amount that you earn. I'll put that in a Roth for you.
Hmm. Hmm.
So I'll put 5,000 in a Roth. You earn the 5,000. You can do what you want with that." Or some parents just do a match and say, "Okay, if you
Sure.
take 2,500 of what you earn and put it in a Roth, I'll match that."
Hmm. Hmm.
Similar to what companies do with 401ks. That's kind of a nice way of doing it for
Okay.
kids to incentivize them to save.
Sure.
Okay. When's the deadline to make a contribution? It's generally April 15th of the following tax year.
Oh yeah, that's right.
Okay. For that part of it. Yeah.
Yeah, but I mean I think that's an important one people kind of gloss over is that you don't have to get it in the year of the tax year. You get all the way until filing day
Yeah.
to put it in, which maybe you've earned a lot of money in the first half or the first quarter of the new year, opportunity to avoid taxes from the prior year.
A lot of people get a year-end bonus that's not paid
Right.
until January, February, or March.
Mhm.
Yep. Okay. How about withdrawals? We talked about contributions. Let's talk about Roth withdrawals. Okay. So qualified distributions are those that occur at least 5 years after the account is opened. Okay. Now, this flies in the face, I guess, of what I told you just a minute ago in terms of 5 years after that contribution went in. So that's something we need to clarify. Okay. And it says at least one of the following conditions have also been met. That you're 59 and a half or older at the time of the withdrawal. Okay, so this is a consideration for people that are looking to retire early, like age 50, let's say, right? If you're permanently disabled, okay, that's fine. And you can use up to 10,000 to use for the purchase or rebuilding of a first home. They're so generous with this amount. I mean, how far does that get you?
Yeah, right.
Okay. And or withdrawals are made by the account beneficiary after the account holder's death.
Okay.
Okay. But really, this first one is the key thing to think about.
Yeah.
Okay. Now, it is also important to add, and they say here, you can always withdraw your original Roth IRA contributions, the principal you put in.
Yeah.
Tax and penalty free at any time.
There you go. You confirmed your confirmation or something.
Yeah. Yeah. But in terms of taking out the growth,
yes, 5 years.
it's 5 years after the account is opened.
Right.
Right. So, yeah. I think I originally said it was 5 years after the amount you put in, but it's just after the account's opened.
Oh, I see. Okay. But if you open the account and don't put anything in.
That's where it gets a little gray. I'm not entirely sure.
Right. Okay.
Yeah.
All right.
Most of the time, I don't have these kinds of issues with clients, right? The intent is to fund it and for a long period of time. We don't typically encounter these kinds of issues, but the rules are out there somewhere. It's just a matter of digging into, how that applies.
Of course.
Okay. That's all the foundation now has been laid. Let's go into Roth conversions.
Okay.
Okay. Unless you have any questions at this point.
I've been asking them. I've been asking them as I think of them.
Okay. All right. When does a Roth conversion make sense? Let's tick through a few scenarios where it would appear to make sense, and then we're going to dive deeper into a couple of situations because I think there's some misunderstanding about when some of these situations really do make sense.
Okay.
Okay. So number one, this is clear. If you expect to be in a higher future tax rate in the future. So let's say you're in a low tax bracket now.
Yes.
You've retired early. You have no income. Maybe you're not collecting Social Security yet, right? Or it's a low income year because you're working on commission or something. It's a low year. That might be a good time to convert because you're in a low tax year. So any money you convert would be taxed at that low rate that you're in currently.
Right.
Okay. So this is the window opens here and says, okay, this is worth considering if you're in this kind of situation.
Or even if you are expecting your income to increase for other reasons. You're not having an off year, but rather you're just, you flatlined and you now expect to continue to earn in retirement while your Social Security is going to be piled on top of that.
Yeah. And that's kind of the second point here.
Oh, I'm sorry.
If future tax rates are likely to rise because due to personal income growth, okay, your tax rate is going to rise because you know that the next few years you're hitting your stride and your income's going up for whatever reason. RMDs, and we're going to get into a specific example with this.
Okay.
Okay. You've been so successful in investing in your IRA that your RMDs are huge.
Spell out RMD.
Required minimum distribution.
Okay. Yeah.
And we'll get into the specifics of that. But when you get to a certain age, currently 73, you're required to take out a certain percentage of your IRA each year.
Right.
Based on the year-end value of the previous year.
Right.
Okay. Or as we mentioned, legislative changes. Your rights could go up because the rules change. Okay. So a couple of these things are kind of in your control and the other one's not.
Right.
Okay. So this is the clearest thing, but even here, there's some wrinkles to this, and we're going to dive a little deeper into the wrinkles in a minute.
Okay.
All right. Number 2, you have a window before required minimum distributions. There, I spelled it out for you, Randy, on this.
Thank you. Good, good.
Yeah. Right. So let's say you retire before age 73, which is the current age at which RMDs are required to be taken. And you don't have any income right now. Again, perhaps you haven't taken Social Security. Let's say you've retired at 65, right? So you've got that window from 65 to 73 before you have to take money out of your IRA. Maybe you've got some cash that you saved on the side and you've got enough money to live off for a period of time and you have no income. That might be a sweet spot for doing Roth conversions.
Yeah, again.
Okay.
Another kind of a low income situation.
Yes, exactly. And I say Roth conversions because you might do this over a number of years.
Right.
It may not just be once and done. We have a lot of people that kind of fill up a certain tax bracket. And so they're doing this over time and making sure that they're using that tax bracket to its fullest.
Right.
And making sure they're not going over.
Okay.
And being mindful of the effect of IRMA, the extra Medicare premiums. Okay. Third one. You want to minimize future taxes on Social Security or Medicare. So again, we talked about this earlier, but RMDs from traditional IRAs can increase your taxable income, which can make up 80%, 85% of Social Security taxable, or push you into a higher Medicare IRMA bracket. So we've already discussed this.
Right.
Roth IRAs have no RMDs, and withdrawals don't count as income for these tests.
Wait, go over that again.
If you have money in a Roth IRA and you're taking it out, that's not considered to be income for these tests.
Okay. So you still have an RMD on a Roth. I wanted to.
No, you don't. There's no RMD on a Roth.
Oh, you don't have to take any money out.
Correct.
Wow. Okay.
Yeah.
That also is new.
Yeah.
Right.
Yeah. Over your lifetime, you don't have to take money out. Now,
Interesting.
those that inherit your Roth
Right.
do have to take it out over a period of 10 years. But they get the benefit of tax-free growth over 10 years.
Right.
Right. And so that is potentially another benefit to the Roths, is you don't have to take it out.
It's a very small thing, but in case you don't cover it later, do they have to pay tax on the principal?
No.
So they pay tax on nothing.
Correct.
As they take it out over 10 years. Okay.
That's correct.
Okay.
Yeah. All right. Number 4. You have large pre-tax accounts and expect big future growth. You may also have small pre-tax accounts and expect big future growth that makes them large.
Yeah.
Right. So, large and small are relative things, I guess, in this.
Sure.
Right. But again, converting now locks taxes on today's balance, while all future growth compounds tax-free in a Roth. Okay. And again, especially compelling if you're heavily invested in growth assets like Tesla, Bitcoin, AI equities, et cetera, whatever you think is going to do well. You might want to have that high growth outside of a pre-tax retirement account, traditional IRA, 401k, et cetera.
Okay. Slow it down again just for a minute. And I'm assuming that many of the folks in the audience might have exactly the same questions I'm having. So on a regular IRA, our 403Bs and things like that,
yeah,
I think, which are pretty much the same rules. When you take out the money each year, you're paying tax on it as you take it out, whether or not it was part of the principal you put in or part of the earnings you've received during the time, or the earnings from the assets that are appreciating, is that not taxed?
Very simply, you're paying tax on the entire amount that's coming out, and the entire amount is treated as income.
Okay, got it.
Because the money that went in, you did not pay income tax on.
Right.
So when it comes out, the whole thing comes out as income.
Including the gains, which is one of the big benefits of the Roth.
That's right.
Okay.
Yeah.
All right.
So you can imagine if you put in, $100
Yeah.
and
Right.
you've got $1 million in the account because you invested so well,
Right.
you're suddenly now be paying higher taxes because you're going to be at the highest tax bracket.
All right. Sorry, this might sound like a personal question, but if you are in an IRA, a regular IRA, or some of these others, and the money's inherited, is it the same rules for the people that inherit in terms of what they pay tax on or don't pay any tax?
If they've inherited a regular IRA,
Yes,
that money comes out as income to them.
they have to pay income tax
Yes.
on the entire amount.
Yes.
Okay.
If they've inherited a Roth IRA,
Mhm.
then there's no tax owed.
And if they inherit that IRA and they're paying taxes on it, do they have the same kind of limits on how long they have to take it out, or can they take it out over a much longer period?
The inherited IRA rules have changed. It
Okay.
used to be based on your own life expectancy and per the IRS table, but now it's over the 10-year period. They've
Oh,
accelerated. They've forced people to take it out over 10 years.
oh, okay. All right.
Yeah. And initially, when they did that, people said, well, I'll just take it out in the 10th year. And
Yeah.
basically, the IRS came back and said, no, we want you to take it out each year for the next 10 years. Yeah.
Okay.
The government needed some money, I guess.
Yeah,
Right?
yeah, I guess so. Yeah.
But it's a classic example of how they changed the rules,
Yeah, yeah, yeah.
right? A lot of people funded these accounts and said, okay, my heirs will get this money and they can take it out over their lifetimes.
Yeah.
And no, that's no longer the case.
Got it.
Now, the people that were already doing that,
Mhm.
that inherited account, they
Mhm.
were grandfathered in and they can continue to do so.
Okay.
So the rules changed, but not for everyone.
Got it.
Yeah. Okay. Number 5. This is kind of a big one, and I think this is one of the most misunderstood ones, and we're going to dive into this a little bit deeper with an example. But the Roth conversion makes sense when you can pay the conversion taxes from a taxable account, not from the IRA itself. So you've already got a pile of money on the outside that you're going to use to pay the taxes that are due from converting the money to the Roth IRA.
Okay.
Okay, so the ideal scenario is that you have cash on hand to pay the taxes, preserving the full amount converted inside the Roth to grow tax-free.
Mm-hmm.
Using IRA funds to pay these taxes diminishes the benefit.
Mm-hmm.
Okay, and this further challenges if you're doing this before you're 59 and a half, right? You may have to pay a penalty.
Yeah.
You're taking it out early
Yeah.
if you're paying the taxes with IRA money.
I see. Okay. All right.
Okay, and we'll talk about one of the big mistakes that people make in this regard. When they do these calculations to figure out does it make sense to do the conversion, it relates to this very issue. Okay, so we'll come back to that in just a second.
The 59 and a half issue, or just the general issue of converting when you do or don't have taxable income out or taxable amounts outside?
The latter.
The latter. Okay.
Yeah. Yeah. The issue of where you get the money from to pay the taxes and factoring the yeah. We'll talk about that in a second.
Okay.
Okay. Number 6. When you want to leave tax-free assets to heirs, right? So the money inside a Roth has no RMDs during your lifetime, and your heirs inherit tax-free growth for 10 years post your death.
Right.
Okay. Again, it used to be over their lifetimes, but now it's just 10 years.
Mm-hmm.
Okay. And again, the comment here is this is especially powerful if your heirs are in a high tax bracket.
So if they leave it in and it continues to grow, they don't pay taxes on that growth either.
Correct.
Wow.
Yeah.
Wow.
Now, essentially, you pass away, your heir gets a Roth IRA. They have to essentially take out, 1/10 of the balance in the first year.
Yeah.
So it's not like they have a choice to leave it in, but they could take it all out at once if they wanted to.
Or they could leave it as much as possible in if they believe that the assets are going to appreciate, especially because it will be tax-free appreciation.
That's right.
Right.
So that's nice.
Right.
Again, it's not as great as it used to be. It's no longer over somebody's lifetime, which was really nice.
Right.
But still, it's something.
Yep.
Okay. And of course, when they take the money out of the Roth, they don't have to spend it.
Right.
That could just be reinvested in just a regular investment account.
Right.
right? So that's for argument's sake, say your account held Tesla.
Right.
They take the money out of the Roth. They've sold Tesla. They take it out. The very next day, they can buy Tesla again.
Right. Right. Or they could put it in their own Roth, right?
Well, if they were eligible to.
If they were eligible. Yeah.
Yeah. Okay. All right. Number 7. You expect legislative or fiscal pressure on retirement accounts. So this is to mean that you think tax rates are going to go higher.
Mhm.
And a lot of people are worried about the fiscal stability of the United States,
Mhm.
worried about higher tax rates, worried about the government, changing the rules. So if you do it, if you convert preemptively, then you're effectively locking in today's rates, and that can't be changed.
Right.
Now, the biggest risk in all this is that you do this conversion, you put this money in a Roth, and suddenly the government changes the rules on Roths,
Right.
right? And puts an RMD on it, or maybe even taxes a Roth if it does really well,
Right.
right? These things aren't beyond the scope of possibility, right?
And typically, though, they would probably grandfather in those who are in the account. There's no guarantee, but it's
There's no guarantee.
probable, right? Probable that, I mean, how can you say probable? But based on historic evidence, they would probably grandfather people in who were anticipating that that was their contract.
You would hope so. But you can also see a situation where, like, Peter Thiel has, $4 billion in his Roth IRA.
Yeah, yeah, yeah.
You
Yeah.
could say the government might say, well, that's ridiculous. These
Yeah.
accounts were never intended to have that much money in them. Now, maybe the rule just applies to him,
Right.
right? If you have $1 million or $2 million in a Roth IRA, maybe that's not such a big deal. Yeah. Again, just something to be aware of.
Sure.
I don't have any words of wisdom in terms of what may or may not happen here, other than the rules will change,
Right.
and could be for the worse, could be for the better. Who knows?
Mhm.
But it's a factor when you're considering this.
Okay.
Okay. When it doesn't make sense. So for sure, if you're in a very high tax bracket now and you expect to be in a lower tax bracket later, you don't want to convert money.
Right.
Okay. So for example, you're near retirement and you're still earning a high salary. You might want to wait until you retire and maybe your income goes down, you're in a lower tax bracket. Maybe then it makes sense.
Okay.
Okay. You need the money in less than 5 years.
Mm.
Okay. Since withdrawals from a Roth conversion have a 5-year rule.
Again, but not the money you put in.
Well, this is my understanding. It's the money you put in, not when it was opened.
Right. But the money that
Yeah.
but I would assume any money you put in, right? Because if you put it in the day you open it, or if you put it in a year later, it's still the money you're putting in.
Yeah. This is an unanswered question from this
Okay.
discussion. Well, I'll have to follow up on that
We'll put it in. We'll try to remember to put it in the comments.
or perhaps somebody knows and they can comment
Right.
for us. But
Right.
the most conservative reading of this would be you do a Roth conversion, it's 5 years from the date that you do that.
Got it. Okay.
Could be better, but if you go in with that mindset, I think that would make sense. It doesn't make sense if you don't have the cash to pay the conversion taxes.
Interesting.
Okay. And also if you are receiving means tested benefits that higher income could jeopardize.
Yeah.
Right.
So back up on the last one. So you say it doesn't make sense, but would it be better on that line to say it makes less sense, or it's not as great, it's not as cool, it's not as good for you if you don't have cash to pay the conversion taxes?
Yeah, the analysis makes it pretty tough if you're using cash from the IRA itself.
Oh, interesting. Okay.
Yeah.
Interesting. Wow.
Yeah.
Another new one. Okay. I'm learning so much.
Although obviously it depends on how high you think your tax bracket might go. Let's say you're in the 10% bracket today and you think you might be in the 37% bracket 10 years from now. In that case, it may make sense because the tax
that's why
rate changes.
that's kind of why I said what I said is, or if you think the stock is going to go crazy,
Yeah.
or if your biggest concern is inheritance, some of those would override, I think, the negative that you're talking about.
It could. And again, nothing is set in stone here. You have to run the analysis for your situation.
100%.
Yeah. In addition to these, this is actually from Schwab. So the first couple bullet points there we've already covered. if this is money that you'll need soon isn't a good candidate for conversion because your assets may not have time to recoup the taxes you have to pay.
Mm-hmm.
Okay. And then number two is you don't have the money to pay the conversion tax or must sell assets that could lead to additional tax hit. Right? Like you've got money outside the IRA to pay the taxes, but you have to sell something to generate that money.
Right.
And now you're going to pay capital gains on that. May not make sense.
Mm-hmm. Mm-hmm.
Okay. And then the third thing, which is different, is if you plan on giving a substantial amount of your traditional IRA to charity using the qualified charitable distribution strategy.
Mm-hmm.
These QCDs can take the place of RMDs, and you can give money to charity as part of your RMD requirement.
I see.
Okay, and some nuances to all that too. But
sure.
If you're going to be giving it away, then why pay tax now? Just let it stay in the IRA, and then you can just give it away from there. Okay.
Yep.
All right. This one's kind of interesting, and as a Tesla investor, this is a nice opportunity. What you would call a low valuation conversion. So let's say your IRA is full of a certain company that goes down 30 to 40%.
Okay.
Because of any reason, market volatility, something the CEO said or didn't say.
Right.
So let's say your portfolio dropped from 800,000 to 500,000.
Mm-hmm.
Converting now, assuming you convert the whole thing, which may or may not make sense, you'd pay the tax on the 500,000, not the 800.
Mm-hmm.
Right? And then when it rebounds to 800,
you don't pay.
Inside the Roth, that whole recovery is tax-free.
Okay.
So there's a tax timing arbitrage, it's called, with this too.
Mm-hmm. Mm-hmm.
Right? So you don't necessarily want to just blindly do this. You want to be opportune about when you convert money from your IRA to a Roth if you're doing the strategy. And in a company like Tesla, there's enough volatility during the year. There's a good chance you're going to find at least sometime during the year where you can, use this to your benefit.
Yeah. And so then that also, and again, maybe you cover it later, but in some cases it might be good to transfer parts, even when it doesn't seem like it's a good idea to transfer all.
Yeah.
It may be good to you have a $500,000 total and maybe 50,000 of it in some year might seem wise. Does that make sense?
Yes, definitely. Again, being mindful of
all the things we just went through.
All the things, the tax brackets, so you get hit, and then IRMA and all that stuff.
Right.
Yeah, you kind of need to run that calculation.
I am always worried about IRMA. That's my biggest concern.
Yeah.
No, I mean my aunt.
Oh, our Aunt IRMA.
Yeah.
Yeah. Well.
Yeah.
Yeah. They should have just called it Karen and be done with it, I suppose. Apologies to all Karens out there. I think it's terrible that we've co-opted a name in that way.
I know.
Yeah. All right. So here's some sort of illustrative examples.
Okay.
And it wouldn't be a certain presentation without some charts.
Oh, I have to have charts.
Yeah. Okay. Let me walk you through this.
Okay.
I ran this analysis starting with an IRA of $1 million. Just picked a nice round number out of the year. The tan bars on the left are assuming you're in the 12% income tax bracket right now. You got $1 million IRA, you're in the 12% tax bracket. Okay. And so let's say your IRA doubles over whatever period you're looking at.
Right.
Okay. So 2x growth. Were you better off by converting that money today converting it to a Roth or just letting it in an IRA?
Right.
Okay. The other variable we need to look at is you're in the 12% bracket today and you stay in the 12% tax bracket. Okay. So if you run this analysis, it looks like you're better off. You're $120,000 more by converting to a Roth. Again, the assumption here is that you're paying the tax with cash outside of your IRA.
Right.
Okay. So, and by the way, before we get more into this, I'm going to tell you why this analysis is incorrect in a minute.
Okay.
But this is what most people do.
I see.
Okay. They run the analysis and they say, okay, yeah, it looks like I'm sheltering that gain. I'm not paying the future taxes. I got 2x growth. This is awesome. And then what happens if I think I'm going to be in the 22% tax bracket? Well, it's even more of an awesome benefit.
Yeah.
And 32. And if I make so much money, and I'm in the 37% tax bracket, wow, look at the money I've saved.
Right.
Okay. Same analysis then if you start out in the 22% tax
I
bracket
see. Okay.
and find yourself in these,
30.
and if you start out in the 32 and you find yourself in these brackets over time. And you can see here there's a couple of examples where it doesn't make much sense.
Right. Right.
Okay. And if you look at this, this is the change in the tax rates down here. So over time, your tax rate didn't change. Over time, your tax rate went up, or over time, your tax rate went down.
Oh,
You can sort of see this line forming here instead of sort of saying, okay, yeah, it doesn't seem to make sense if my tax rate goes up. Sorry, this is the difference in tax rates should actually be flipped here, I think, but it works in your favor if your future tax rate is lower, right?
yes.
No, I'm sorry.
No, you were
Higher.
the first time. Yeah. Higher.
Yes.
Yeah.
I'm
Right.
messing myself up here.
Yeah.
Yeah, if your tax rate goes up in the future,
Right.
converting now
Yeah.
makes sense.
Right.
Okay. Sorry, I'm fixated on what's wrong about this, and I'm going to show you right now what is wrong about this.
Okay.
All right. The problem with this analysis is that people didn't include the opportunity cost on the money that they used to pay taxes with,
Okay.
right? They did the conversion from the IRA to the Roth,
Uh-huh.
and they paid the taxes with money that's sitting in savings or whatever.
Right.
But you really should do the analysis and say, okay, let's look at the opportunity cost.
Right.
And for this particular set of numbers, I've assumed that you are investing in the same thing that you invested in the IRA. If you're buying Tesla in the IRA, you could buy Tesla on the outside with that savings.
Right.
So at least it's an apples to apples comparison.
Right.
Now, people may not actually be doing that, but in terms of running the numbers, I think this is a better way to look at it.
Sure.
Okay. And in that case, if your tax rate stays the same, there is no benefit.
Okay.
If your future tax rate goes down, you're destroying value.
Mm-hmm.
Okay.
Yep. Yep.
And the upside benefit to converting doesn't seem nearly as big.
Got it.
And in reality, it's a straight line
Hmm.
in terms of how these line up.
Okay.
Okay. So if your future tax rate is going to be higher, then sure, there's a benefit.
Right.
And if it's going to be lower, then there is not.
Not.
Clear as day.
Okay.
Okay.
Mm-hmm. Mm-hmm.
Now, the interesting thing about this analysis is whether it's 2x growth or 10x growth, that line looks the same.
Hmm.
The relationship doesn't change.
Okay. Mm-hmm.
But what does change is the magnitude of the dollar amount.
Mm-hmm. Mm-hmm.
And if you recall to our tax brackets, those tax brackets are based on dollar amounts, not just percentages.
Mm-hmm. Mm-hmm.
Right? As you hit $750,000, you're in the highest tax bracket if you're married filing joint.
Right.
So the dollar amounts do matter here.
Mm-hmm.
Okay. Certainly, if you find yourself in a low tax bracket today and you think you could be in higher ones in the future, it's pretty much a slam dunk to do the Roth conversion. If you can pay with money that's outside of the IRA.
Okay.
Pay the taxes.
So I know that most of the people watching my channel are nearing retirement or are retired. But what about if you're 30 or 40? Is it better to convert at that point and start only doing Roth from then on, since likely you're going to continue to see increases in your income?
Well, again, is that person that's that age, what tax bracket are they in today?
Okay. So if they're already in a high tax bracket, maybe not.
Maybe not.
Okay.
And again, what do they think their tax bracket in the future is going to be?
Right.
You have to run the analysis
Got it.
for each individual person and where they're at today and what resources they have and what accounts they
I'm
have
just trying
and
to
so
make
on.
the general rule is if you're 35, you're probably going to be making more when you're 45 and the tax bracket will be higher, et cetera. Yeah.
Well, if you're assuming that, then yes.
Yeah.
But there's no guarantee of that for anybody.
100%.
Yeah. Okay. So let me just restate this again because this is an important point.
Okay.
You have to factor in the opportunity cost of the money that you use to pay the taxes with.
Right.
If you don't do that, then this analysis gets skewed in favor of converting.
Mm-hmm.
If you do factor in the opportunity cost of that money,
Mm-hmm.
and again, I think the fairest way to assume is say, well, if I'm buying Tesla in my IRA, I can buy Tesla in my regular taxable brokerage account.
Right.
So this analysis kind of equalizes that.
Mm-hmm.
When does converting to a Roth make sense? Otherwise, why don't you just take that money in the taxable account and just buy Tesla there?
Mm-hmm. Yeah.
Right. Now, a lot of people say, well, I'm not going to because that's my savings money. It's my cash. Well, you're willing to pay taxes with it, then why wouldn't you invest it if you're willing to part ways with it to pay taxes?
Right.
So it's a little bit of mental accounting going on there in terms
Yeah.
of how
Yeah.
people view that sometimes.
Mm-hmm. Mm-hmm.
Okay. But you can certainly see the higher the tax bracket you're in today, the harder this analysis is to justify doing a Roth conversion.
Got it. Yep. Yep.
I
Yep.
think would be a good
Yep.
conclusion to draw.
Yeah.
It's kind of a, nothing's a slam dunk, but it's more likely to be a slam dunk if you're in a low tax bracket today.
Yeah.
Okay. All right. Let's talk about RMDs.
Okay.
Because one of the things that I've been out there talking about is, well, you invest in a company like Tesla and it grows some phenomenal amount and you've got 10x the amount in your IRA today, or maybe even 20x at some point in the future.
Mm-hmm.
Have you considered how big your RMDs might be
Mm-hmm. Mm-hmm.
and what impact that has on things?
Sure.
Okay. So RMDs now are the starting age as of 2023 is now 73 years old. It was 72.
Right. Long time ago, it was 71.
And before that, yeah.
When I retired, I'm sorry, when I hit the age, it was 71 rather.
Yeah. So for people that haven't yet reached 73, right, this is kind of for them. For people that have already reached RMD age, they already know the drill. They know what this is. Right. So the RMD, the required minimum distribution, is the amount that the government requires you to take out of your retirement accounts.
Mm-hmm.
And it changes year to year based on your life expectancy.
Mm.
And the life expectancy comes from what's called the Uniform Lifetime Table that the IRS publishes.
Mm.
And sometimes that table can change, right? As they run the numbers and look at life expectancies, that these numbers can change.
Right.
Okay. So here's an example. This is table 3. This is for people who have a spouse that is not more than 10 years younger. There's a different table for those people. Okay. The government actually encourages people to marry younger people.
It's incentivized.
Not something we're going to dwell on in this situation, but yet you are required to take out less if you marry somebody really young.
Okay. All right.
So all you 90-year-olds out there, marry somebody who's 40.
Yeah.
That
or
maximizes.
Even 79.
There you go. Yeah. All right. When you turn 73, you are required to take out 1/26.5 of your portfolio.
26.
Okay. So this is a factor, or this is a divisor. So if you've got, let's say, $1 million in your IRA, divide it by 26.5, and that's how much you have to take out.
Okay. All right.
As you get older, the RMD factor goes down. But that means you're taking out more and more and more. So by the time you're age 100, you're dividing your portfolio value by 6.4. So you're taking out 1/6 of your portfolio at that point.
All right. Okay.
Right. So the government is saying your life expectancy is now decreased. We want you to take out more.
Right.
Your life expectancy is decreased. You lived another year. Congratulations. But your life expectancy is decreased. We want you to take out more.
Okay.
Okay.
Uh-huh.
All right. Here's an example of how that works. So let's say you just turned age 73 and you've got 500,000 in an IRA.
Mm-hmm. Mm-hmm.
Your factor is 26.5.
Okay.
Your RMD amount for that year, for the next year, is going to be just under 19,000. And that would put you, all things being equal, not including other things that might impact your taxes, in the 10% tax bracket for joint filers and in the 12% tax bracket for single filers.
Mm-hmm. Mm-hmm. All by itself.
All by itself.
All by itself, not counting the fact you might be pushed up by Social Security, pushed up by other.
Correct.
Yeah.
Yeah, I'm just looking at this solely. Yeah. Most people are going to have other sources of income that will add to this.
Right.
And then they'll have some deductions that reduce, there's other things.
Sure, sure, sure.
I'm just trying to
Yep. No.
simplify it here.
And by the
But
way, and by the way, dividing by 25 is such a, I mean, who would have ever thought of that? It's roughly 4%.
yeah,
It's another way to look at it.
yeah, that's right. No, yeah, they could make it easier to think about, but they like to talk in terms of factors. Yes. Yeah. Now, let's say you've got a portfolio then, just to jump ahead, let's say it's $8 million.
Right.
Okay. Well, 1/26 and a half of that is $302,000.
Mm-hmm.
By itself, that would put you in the 24% tax bracket
Mm-hmm.
and 35 for single.
Mm-hmm. Mm-hmm.
Okay. Now, I didn't run these numbers so that this shows exactly where you cross that threshold, but
Right.
just giving some examples here. If you did have 20 million in an IRA, both filers would be in the 37% tax bracket. Now, you may say, CERN, some of these numbers are crazy. Well, if you have $1 million in an IRA today or a retirement account today,
Right.
and you own Tesla,
Yeah.
if it 10x's,
You've got 10 million. Yeah.
you got 10 million.
Yeah.
If it 15x's, you're in this range. If it 20x's over time, you're up here.
Yeah.
There's a lot of people that already have this much in an IRA
Right.
that if it 5x's or whatever, like they're in some crazy territory already. So,
Mm-hmm.
and a lot of those people are not in the highest tax bracket yet.
Right.
So this is why I've been telling Tesla investors, growth-oriented investors, be careful about what you're investing in your IRA.
Mm-hmm. Mm-hmm.
If it's your only savings vehicle, then fine, absolutely get those returns, but just understand what kind of a tax mess you might be creating for yourself by doing that. And again, this is not the end of the world. This is a dream for most people.
Right.
But if you have an opportunity to do Roth conversions at some point,
Yeah.
then maybe you do that.
Right. Right.
Or if it's early enough in the game, maybe you don't put money in an IRA and just save it outside in either a Roth directly, or if you can't, this in a regular brokerage account.
Right. Right. Yeah, you mentioned that before. We did this about a year ago or so, and you mentioned sometimes you're better off not to put the money into any kind of a pension plan. That over time it works out better to not put it in a pension plan.
Yeah, and if you think about this, if you just bought the stock in a brokerage account,
Right.
you don't have to worry about whether you've met 5 years
Right.
to take it out. You don't have to worry about whether you're 59 and a half. I mean, who celebrates their half birthday?
Right.
I guess when you're 59 and a half, I guess you can. Right. You don't have to worry about all these weird things.
Yeah.
You just pay your tax, buy the investment, and you're total control of it. And in addition to that, you can borrow against it, where you can't really do that in your IRA.
Now, I know that Stephen Mark Ryan and others talk about the fact that they have two accounts, and they have the more aggressive, Tesla investments or whatever in their Roth.
Yeah.
Because they're expecting a big multiple, and they don't, and if they want to take it out now today, they don't want to pay the capital gains.
Right. Yeah, and again, everybody's different.
Right.
Situation's different. Not everybody's all in Tesla.
Right.
Not everybody has all their money in a traditional IRA or 401k.
Right.
A lot of people have IRA money, 401k money,
Right.
Roth money, and also a sizable after-tax or individual or joint brokerage account as well.
Right.
So different tax buckets, different tax types, different investment strategies. All that needs to be factored in when you're looking at this.
Right.
But my point with this is, if you're investing in a company like Tesla that we think can compound a lot over the next 10, 15, 20 years, a lot of people may find themselves up in this area.
Right. But that wouldn't, again, it's hard to call that a bad thing. I know I've had business owners over the years go, oh my gosh, I might make 170,000 this year and I'm going to be in this higher tax bracket. I'm like, yeah, but it's not 100% tax bracket.
Right.
You've made more money.
It's not a terrible thing. Again, it's a nice problem to have,
Right.
but if with a little bit of forward thinking, you can avoid that,
Right. Yeah.
then it's worth thinking about, in my opinion.
100%. Get it. I understand it. Maybe,
Right.
hopefully everybody else does too, but I do.
Yeah. And this is something that I don't hear from really any other advisor. They discuss the benefits of Roth conversions, but
Yeah.
don't really make it clear to people if they do fabulously well in their investing, what the implications might be. I don't hear other people talking about this, Randy.
Yeah. So what I heard, and maybe another advisor would give all of the rest of the advice that you gave, but I thought things like the timing of making a conversion or not making a conversion seemed like way more important than whether I have to pay 37% of my $20 million. I mean, are of the amount I have to withdraw, I'm withdrawing on on that amount. Yeah.
Yeah. And again, each person's situation is going to yield a different result here, a different scenario. And hopefully we're giving people kind of enough of a broad explanation to they can see in their situation where it might apply. Okay. Again, talk to your financial advisor, talk to your, accountant, et cetera.
Yeah.
Through all these issues. Accountants are great. A lot of accountants, though, are not investment minded. A lot of accountants aren't necessarily going to think about your $1 million IRA today could be 20 million 15 years from now. They're not going to be thinking that way.
Yeah. Yeah. In fact, if you tell them that, they'll just scoff.
Right. Or if you tell them you're all in Tesla, they may say, well, your $1 million IRA will be $1 million 15 years from now. Like they'll have low expectations. So
right.
Just be careful about, how people's advice may be shaded their experience or their opinion about different things.
Sure. 100%.
Including mine. Again, including mine. Don't, same thing. Okay. So key insights. Investment returns do matter if it kicks you into a higher tax bracket.
Right.
All right. And how much it matters, that's up to you. Some people don't want to pay $1 more in tax than they should, or could have avoided it. They get upset with paying any more in tax. Other people couldn't care less. So that's a value judgment. I leave it up to everybody to figure that out for them.
Sure.
If you expect future tax rates to be higher, in general, the Roth IRA wins. Right? The government's going to raise the tax brackets.
Right.
Right. If you're worried about that, then getting money out of a traditional IRA 401k likely makes sense.
Or if you're going to be making substantially more money, which would raise you into another tax bracket.
Which is the purple line. If you expect your future tax rate to be higher, Roth IRA likely wins as well. Okay. The one thing too, in my analysis, when I ran the numbers earlier, in looking at the opportunity cost, if you invested that money outside the Roth and just in a regular taxable account instead of doing the conversion, I assume that you didn't sell the stock. There's no capital gains that you're paying.
Right.
So basically, you pass away with that stock in hand. So if you factor in the fact that you might need to sell that stock at some point, then there's a capital gains drag, which would slightly favor the Roth if you're factoring that in.
Okay.
Okay. And if you pay the conversion tax from the IRA itself, the break-even level shifts much higher, right? So the Roth becomes much less favorable in that scenario if you're paying the tax from the IRA.
Which we talked about in detail.
Which we talked about. Just want to reinforce some of these things.
Reinforce those. Yeah. Yeah. No, I knew that this was a summary.
Yeah.
I know that never mind. It wasn't going to be funny enough to continue. So.
Okay. I'll give you a chance. Let's talk about a couple of interesting scenarios now.
Okay.
Let's say you are not able to contribute to an IRA. Because your income's too high. Okay. You've heard of a backdoor Roth IRA.
I have never heard of a backdoor IRA.
Okay, so let's talk about this.
Okay.
So it is a legal workaround. Now, don't take this from me. Again, I'm not a legal expert. So to say it's a legal workaround, I guess remains to be seen. But people have been doing this now for years.
Okay.
And they've quote unquote gotten away with it.
Yeah.
So it's legal in that sense. It's been out there. The IRS has had plenty of time to challenge this.
They haven't.
And they haven't. But there's nothing set in stone, I guess is what I'm trying to say.
Yeah, yeah.
Okay, so what is it? It allows higher income earners, people that wouldn't be able to contribute to a Roth, to contribute to a Roth, even if they earn too much to contribute.
Mm-hmm.
Okay. Now, again, the proviso here in the white box, the backdoor Roth may not last forever. The strategy has existed for many years. The IRS has not provided formal guidance on whether it violates what's called the step transaction rule.
Mm-hmm.
When applied, treats a multi-step transaction as if it was a single transaction for tax purposes.
Mm-hmm.
So the backdoor Roth IRA requires two steps, right? You put after-tax money into an IRA, and then you take it out and convert it to a Roth. And because it's two steps, you could argue that that really is functionally as one step. And because your income's too high, you violated the rule.
Right.
But yet people have been doing this for years. Again, I am not a legal expert, not a tax expert. Rely on those advisors to advise you whether or not this is okay for you.
Okay.
Okay. How does this work? As we talked about, the IRS sets the income limits for direct Roth contributions. Okay, and we covered earlier for 2025, it's 150,000 for single filers and 236 for married filing jointly.
Right.
And then once your income goes above 165 and 246, you can't contribute at all. You've gone through that phase out period. Okay. However, there's no income limit on traditional IRA contributions, the non-deductible ones. Okay. And there's no income limit on conversions from a traditional IRA to a Roth IRA. So high earners can convert indirectly via this two-step backdoor process.
I get it. Okay.
Okay. So you put the money into a traditional IRA,
right?
Non-deductible contribution,
right?
Okay. And then you convert it.
Got it.
And you do it like, the next day or whatever, like you just want to.
Now, if you did it the next day, it might seem more like there was, an intent there to make two steps into one. To avoid the two-step rule. But if you waited a year, maybe it seems more like you had an epiphany.
Yeah. Well, I won't give any advice on the timing of this. Again, seek out your own guidance on that.
I'm just throwing out ideas here.
Yep. Right. So there's that.
Right.
Here's the thing, though, to be very aware of. There's this pro rata rule. So a backdoor Roth is really simple if and only if you don't have another pre-tax IRA money, traditional IRA, SEP simple.
Okay.
Because the IRS views your IRAs as one combined account. Okay, so let's say you've got a traditional IRA, you've got 500,000 in.
Right.
And you open up this other account and put this money in and then convert. Well, the IRS is assuming that that's one big account. So what they do then is they say, well, you have existing IRA funds, a portion of your conversion will be taxable now.
Right.
So you just need to be very careful of this. Now, there's a workaround that.
Okay.
If you can, you could move existing pre-tax IRAs into a 401k or other qualified employer plan, since those aren't counted under the rule.
Got it.
Again, this stuff can get needlessly complex.
Really trouble. Yeah.
But just so people know that if you're in that situation, there may be a workaround for you depending on the options available to you from your employer's plan.
Yeah. We want to keep the lawyers, successful, making lots of money, living in the big house.
Yeah. Okay. That's the backdoor Roth. Now we want to talk about the mega backdoor Roth.
The mega backdoor Roth.
Even better. All right. Here we go. If your employer's 401k allows after-tax contributions beyond the normal pre-tax or Roth limits, okay, and in-plan Roth conversions or rollovers to a Roth IRA, then in theory, depending on the plan and how it's constructed, you could effectively move up to $69,000 a year, or if you're 50 plus, 76,500 a year, 2025 numbers, into this mega backdoor Roth.
Yeah.
Right. So talk about getting around the rules, not just the 7,000 or the 8,000 if you're over 50 limit, but mega amounts of money, relatively speaking.
Yes.
Not that $69,000 is a mega amount, but relatively speaking, it is. Okay, so this again, just planting a seed here. We don't want to go into the details on this too much. There's some IRS paperwork you have to fill out, the form 8606, where you keep track of all this. Again, people have been doing this for years,
Sure. Okay.
and is an IRS form to fill out to make sure it's legitimate, right? That you're telling the IRS you're doing this.
Yeah. Yeah.
But this also can be very interesting for people to shelter a decent amount of money, particularly if you look at it over, 10-year period
Mm-hmm.
in a Roth IRA.
Mm-hmm. Okay.
Okay.
Mm-hmm. Got it.
So with that, Randy, that is probably confusing enough for everybody.
It's enough for one day, huh?
Yeah.
So, well, sir, that was, as always, a very concise, a very well structured, and I hope people liked it. Let us know in the comments below. On X, please share, like, do everything on X. Make comments. What do you call it? Quote repost with your thoughts. That would all be appreciated. Now, by the way, you can do that with the book too. You can quote repost when I'm posting or when CERN's posting about the book. That's really, really super helpful to us. Yeah, so man, I learned a lot. I don't know about anybody else, but I learned a ton
And let me just
because
say
I've been
this.
thinking about those very things, and it's like, yeah,
Yeah, let me say this too, Randy. I feel like we may have caused just enough confusion out there. And let me just say, I'll make every attempt to respond to questions and comments
okay,
on X and YouTube around this
right,
to the best of my ability. Again, I've got a pretty busy week ahead, but I'll do my best to respond to questions. Again, I'm not providing investment, tax, or legal advice here, but hopefully I can maybe link to some different resources to the extent there are questions about certain things.
sure,
Um, the most important thing I think is to consult with people that actually are licensed to give you the tax advice on this.
right, right. And
Right. But hopefully we've generated some ideas here.
another thing people could ask in the or put in the comments and on X is what else would you like to hear about that is in this realm? Because there's an awful lot of things that we who are retired or on the way to retirement, probably a lot of other questions that are in this financial with all of the tax implications, all of the inheritance implications, et cetera. So maybe there's another major subject you'd like CERN to jump on.
There's that, and also actually with this one too, if I find that there are a lot of very similar questions, maybe we'll come back and do a Q&A
Right,
follow-up.
right, 100%. Yeah, yeah.
Yeah.
And then I don't know, CERN. You can say it. I can say it. I think it's better if I say it. If you really want some great advice, you could call CERN, and maybe you want to move some of your activities, some of your financial efforts over to CERN's company, because of course it is a brilliant company and gives absolutely brilliant advice.
Yes, thank you for that, Randy. The thing I think I would say here is don't inundate me with questions about Roth conversions. The focus of my firm is more on the investment side,
Mhm,
right,
mhm.
and helping people through that. But certainly related to all that is, where is the money best invested,
Right,
right? What accounts?
right.
But again, I'll do my best to answer any questions that people have in the comments.
Mhm, mhm.
Yeah.
All right. Okay, so with that said, I think we've covered everything we need to cover. Earlier today, there would have been my regular Monday morning show, which happens on Sunday night. I know it's weird, but we talk about what's going to be happening in the week ahead in terms, and this is going to be a pretty busy week in terms of the stats that are going to be coming from the government and other people. That's all going to be kind of going into the Fed decision the following week. So many of those stats might impact the Fed's decision, as we saw over the last 2 weeks, where it went from 70% yes to 35% yes, and then back to 90% yes. So that doesn't mean that we're going to be at 90% yes at the end of next week.
Who's going to be the next Fed chairperson?
Waller? Seems like it.
Okay.
I mean, he practically declared himself. I mean, if you like guys that are pompous, I thought that was a little pompous. It's like, well,
That
yeah,
might go down well with Trump. We'll see.
I'm obviously the best for the job. I mean, that's confidence, right? So that would be my best guess, but I don't know. We'll see, I guess. We're supposed to know maybe before Christmas,
Yeah,
according to Mr. Besant.
there we go.
All right. So yeah, so I'm going to put the card up. You know that they've done this new thing on Zoom where it
I see that
moves
the camera just moved on you. Yeah.
as I move up or back, it decides if, yeah, it's a lot of fun, but yeah, I noticed it yesterday or Friday with Larry. It was moving all around. I don't know what he was doing. CERN, as always, thank you so much for jumping on. Thank you for all that you do for the community and to all of you out there. It's been great talking to you.
Thanks, Randy.